I figured it would be smart to kind of run through how processors evaluate cash flow. And there's a few different things that they're looking at, but I wanted to break it down to be fairly simple for our viewers today. And basically, they're going to look at what your revenue, your sales are, right? But then they're going to, what are the things that are directly, immediately impacting cash flow before anything else happens in your business, right? So refunds and chargebacks, they're going to take those out. So if you're processing 100 grand in sales, you got 9 grand in refunds, you got 1,000 in chargebacks. Basically, 10% of every dollar is going right back out before you even have any of your operating costs, right? You got your payment processing fees, 3%. You got cost of goods, you got media, you got all these other expenses. So the higher that number is, the more concern that they may have. And actually, this is something to evaluate as you're evaluating businesses as well. What's the cash flow requirement? If they stopped taking new sales today, what's going to be coming out month 2, month 3, down the road? What's the commitment? Because that's what some of the payment processors are looking at when they're evaluating risk on a business. You got 20% refunds, 25% refunds, right? Okay, plus chargebacks. Like, they can add up pretty quick. And again, if you stop taking sales today, how much cash you need to carry to float that business. And that's one of the things that payment processors will do when they're evaluating, what's the risk of this deal.
Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller?